as the year goes on, what can we expect to move stocks? More the Fed or earnings? We have Dana Dioria, Envestnet PMC Co-Chief Investment Officer. Dana, it's good to talk to you today. Let me just get your read, first of all, what we got from the major banks, what you think this says about where we're headed in the weeks ahead from some of the results getting from the major companies.
Well, I think, there's definitely, obviously, interest rates are the big driver here. So I think so far, so good from that perspective with banks. But, there's a long way to go in this earnings season. I think what's interesting about the earnings season is just, considerably high expectations for EPS that persist. And, an expectation, even if you look out like all of 2024, what the expectation is both from an earnings growth perspective as well as, market. And, a lot of that is going to depend on ability to keep having productivity gains, keep being able to stay in a place where, we can keep margins under control. So, I think there's a lot of positivity very much worked into the market. I'm sure that's not a view that you're, anything revelatory there. But so far, so good with the start, right?
Indeed. So as we're just at the beginning here, what are some of the earnings bellwethers that you're going to be looking for and what you'll be sort of passing through as you look at the forecasts?
Yeah, I think certainly financials, but I think, it's hard not to say all eyes on big tech and communication and, those magnificent seven stocks, because let's face it, at this point, 30% of the index, where goes those stocks goes the index and the economy at large, right? So I think those are going to be places that we're going to look heavily. I think there's going to be a lot of interest around, are these defensive positions the way we've been treating them in the last couple of years now, where, it's the place to go if we end up in a risk off type of situation, which we are, of course, not right now. And that's why you're seeing them behave the way they are. But earnings is where you kind of start to suss out, how cyclical are some of the revenues that those companies depend on, ad revenue, for example, where if we do kind of trend into, a light recession, even which you're getting some forecasts for now, right? I think there's kind of a, hey, we're going to stick the landing or maybe, a light recession. I think that's where you're going to get some insight from those companies.
Dana, or in the first few weeks of this year, so certainly investors kind of still looking at their portfolio to see what the outlook's like in 2024. You've talked about the amount of cash that's sitting on the sideline, $6 trillion. How do they put that to work?
Yeah, well, I think, as a starter, it's an interesting thing to look back on this year. And, you had a lot of it. Where I am, we're looking at the financial advisor space, and you have a lot of advisors who oversee the managed accounts of their clients. And a lot of clients kind of taking money and sitting on the sidelines, locking in or taking advantage of the high cash rates. And so we see money markets at $6 trillion, double what it was not that long ago, right? So where did we go with that cash? Well, yes, you locked in and you got higher rates for the cash. But at the same time, if you did that, you missed an absolutely phenomenal year in the equity market. S&P 500 up 26%, but even small caps, even international stocks, double-digit returns here. So if you're in the market typically, and you were pulling money out of the market, kind of waiting for this downturn, waiting for this recession, and saying, "Well, I'm just going to go in the risk-free because I'm finally getting paid there," you missed out on a phenomenal year. Standard 60/40. There was a lot of consternation this year about the 60/40, right? Because for 5 minutes there, equities and bonds were showing some losses at the same time. And everybody's, geez, maybe I should just go to cash. I think 2023 is going to stand as, one of these cautionary examples and tales for financial advisors to talk to clients about, that you really can't market time. You really have to kind of stay in the market and wait out the bad with the good in order to get the return, because as we know, it's not 10% year after year. It's years like we just had, 26%, and then maybe some negative years, and you put them all together and you hopefully get around 10 to 12%.
And you raise a good point, because a lot of people are still trying to buy the dip at this point, trying to time the market, which, as you mentioned, never a good idea. But as you look at the most beaten up sectors over the past year, utilities and energy, how much upside do you expect heading into 2024?
Yeah, I think, well, that's the name of the game right now, right? So if you look at valuations, of course, we know, I mean, starting with the Magnificent Seven, very, very priced to perfection. But large caps in general, just sitting at, obviously, we come into the year at 19 times on, your standard S&P 500 index, and, looking at price to earnings, and you're saying, okay, where should I position? I think there's two ways to look at it. One, you can look at some of these sectors that you're mentioning, some of these areas of the market, like small caps, for example, even international. International developed is running at about average valuations. Emerging stocks are below average valuations. But those sectors that have been beaten down, small caps, international, they're all valued more attractively than your standard large cap index, right? And so if you're thinking in terms of a long-term play, we know that buying at a lower price tends to pay off over time. If you're thinking in terms of short run and what do I expect to happen, we know obviously that December was a phenomenal month. In fact, if you look at the earnings of small caps last year, the vast majority of the earnings of the entire year happened at the very end of the year. So we're clearly on a run with these beaten down areas of the market. And to a certain extent, there's probably some momentum behind that. We're still getting some good numbers coming in that sort of feed the fuel or fuel the fire, for, kind of that risk on view. The one caution, and you have to be willing to sit through this, is small caps were beaten down, for example, and probably in large part because they're interest rate sensitive. And so if the market's pricing in 6 rate cuts this year and we don't get all 6, there are reasons to think there could be cracks. We've got an election year ahead. We could have volatility in the market that kind of affects these areas. But if you can kind of sit through it, valuations suggest you have a good play for the medium to long term.
Yeah, a lot of potential risks to navigate there for investors. Dana Dioria, Envestnet PMC Co-CIO. Good to talk to you today. Appreciate the time.